So welcome everyone to the Austin Women's Investing Group. We are a group of women who, originally started in Austin, Texas, but now it's kind of gone farther than that. We're a group of women now, I think probably still mostly based in Austin, but I know we have other people on the call who maybe don't even have a connection to Austin. We've been really fortunate to have a couple really cool pieces written up about us in national publications in the New York Times earlier this year, and then another one in Real Simple magazine. And I just love that our story resonates with people. And I also, one of the benefits that is coming out of this is that now we can be not just a group for Austin, but we can be a group for women worldwide who are looking for some of the information that we spend a lot of time talking about here. So the Austin Women's Investing Group is a group of women who get together to talk about finance and money and investing. And really, as one of the founders here, I think it's become really important just to make clear to everyone that, this group for me, and I think for the women who are here, this group exists to put more money and more resources in the hands of women, right? So we're here to help women build wealth and have more resources at their disposal. And then, each person can decide how they deploy those resources. But that's really, what this whole group is about. We are organized by volunteers. We rely on volunteers to come in and lead the discussion. I find myself leading, I don't know, maybe 3 to 4 meetings per year, but the rest of the meetings are really, we ask other experts and other thought leaders to come in and share with us. And that's just really what the group has always been about. We have people who come in, share their knowledge. Sometimes those people are subject matter experts. Sometimes they're people who are just passionate about what they've learned and they want to share with the group. And for those of you who have been to an in-person meeting, one of the great things about this group is that there's so much learning that happens from your fellow members who are sharing their experiences and sharing what they've learned through a lifetime of investing. So, we've really been able to, not perfectly recreate, but recreate that dynamic in that chat box that you can pull up on these virtual meetings. If you have a question, ask it. Like at any point in time, ask the question. Sometimes the person next to you on your Brady Bunch screen will be the one answering it, and she'll be the one sharing her experiences with you. And that's just what makes this group so cool, right? It's peer led, and we're here to share our experiences. So definitely, I always love going back after the meetings because I spend a lot of time talking, but then I get to go back at the end of the group and see all of the discussions that you all have had over the course of the meeting. So definitely do that. And as I mentioned, Gwen and Lori here, who are co-organizers, they'll be looking at that chat box to see if there are questions that maybe I can ask the group at large or that I can help answer. So that's where the questions go. Let's see, what else? Nothing in this group is intended to be individualized investing advice. My day job is as an investment professional. I'm the founder of Black Barn Financial, which is a registered investment advisor. I have clients who I give investment advice to during the day, but that's not what I'm in this capacity. I'm not here giving investment advice. I'm certainly here giving my opinion on the stock market in this case, which is what we'll be talking about, and hopefully giving some education and some insight into what's going on in the markets, but it's not intended to be individualized investing advice. And that goes for anything that's in the chat box too. We're all here to learn from each other and to get resources from each other. So I think maybe without further ado, I'll see if I can figure out how to share my slide deck. And we'll just kind of get going into our topic for today, which is the stock market. I know there's a lot of new people in the group. So, one of the things that didn't occur to me is that if you have been a member of the group since about March, you've noticed that we talk about the stock market a lot, like March, April, May. We've talked about it not literally every single month, but most months in the recent past because of what is happening in the stock market. We don't typically cover the stock market to this degree in normal times, but these aren't normal times. So, I love talking about the stock market because I believe it's one of the tools that you need in your arsenal to generate wealth. And so I love talking about it. I love educating about it. And I love giving you all the opportunity to make the choice about how you invest by knowing more about the stock market and how it might work for you. So here, sharing my screen, I think this is all kind of up and running. So today is August 22nd. As I just mentioned, we're talking about the stock market today. Next month, at the beginning of the month, Kara Perez from Bravely Go, who has just really been another huge resource for many of our members. She's going to come in and talk about flexibility and resilience in financial planning. So highly recommend that you RSVP for that event. We'll be sending out the invitation shortly. So if you haven't gotten it in your inbox through Meetup, it will be coming. But you can mark your calendar that she'll be doing that on September 5th. So excited, always excited to hear what she has to say. All right. Again, please use the chat box to introduce yourself to the group. If you want to get to know each other, that's the part that I miss the most about not having in-person meetings. We used to always spend 20 or 30 minutes introducing ourselves to each other. So if you don't mind doing that in the chat box, just something really quick and simple, that would be really nice for the other people who are on the meeting. But it's also where you can ask questions. It's also where you can answer other people's questions. All right, so if we keep going, here we are. There's a bunch of kind of disclosures, disclaimer language on these first two slides. This will be sent out with the slide deck that goes in the follow-up email. We'll send a link to the video, and we'll also send a link to these slides. A lot of this has to do with the concept of past performance is not indicative of future results, which in investing in finance, it's a fancy way of saying we don't know what the future is going to be like. I have some slides, I have some charts to show you. Really, we're using what we know about the past to try to make educated forecasts and guesses about what might happen in the future. But I'm sure, it goes without saying, but we have to say it anyway when we do this, the future is not going to be just like the past, right? We're doing the best we can to gather information and make good forecasts about what we expect to happen in the future. So a lot of this disclosure language, that's what that has to do with. A little bit about me. I'm just going to keep this really short. As I mentioned before, I'm one of the founders of the Austin Women's Investing Group, so I've been here since 2011, leading groups, meeting new members, bringing in experts to lead some of the meetings, and it's been, it's grown larger than I ever expected it ever would. It's really been the most amazing experience, and I'm so happy we're able to continue going even through 2020. And it's become even more popular and more important than ever. I also teach classes through UT's Informal Classes program. I've been teaching a class called Investing for Beginners and a class called Introduction to the Stock Market since 2011. So I know a lot of you, there's a lot of cross-pollination between the Austin Women's Investing Group and UT's Informal Classes program. So I've been, again, delighted to be able to be a part of that program as it's grown. And then I'm the founder of Black Barn Financial, which is a registered investment advisor here in Austin. So again, I know I mentioned this, and I'm an investment professional by day. I have clients who ask me to give them and implement investing advice. That, again, has been something, it's a passion project, and it's something that I'm really excited to be a part of. All of you, again, if you wouldn't mind sharing with the group, just your name, what you do during the day, how you found the group maybe, and what you're hoping to learn. There's a lot of networking that can be done in a really fun, casual way in the group. We tend to attract certain types of women who love learning new things. You might find people who are colleagues in your industry or resources in your industry. So that can be something that you do in the chat box as we continue along. All right. So let's launch into the stock market. For those of you who have attended either classes or Austin Women's Investing Group meetings in the past, a lot of this, because a lot of it is the same, the same information that I come back to time and time again. So some of this will be familiar, some of it will be new. Some of it will be basic, some of it will be more technical. So I'm really kind of trying to pull in all different types of information in order to offer as much insight as I can in the next 2 hours. So if we just back way up and talk about what the stock market is or what stocks are, stocks are ownership of a company. That's really, really important because it's not the same as a lending relationship. If you are investing in bonds or loans, you are lending someone money and those people have to give you your money back plus interest, right? Stock is different. It's ownership of a company. So we'll talk about, how that flows through investing decisions, but it's really important to know, like, okay, if I own a share of a company, I'm a part owner in that company. The price of a stock is simply where a buyer and a seller agree to make a transaction. That's actually what the price of anything is. What the price of everything is where a buyer and a seller agree to exchange. So it's the same in the stock market. The stock market opens at 8:30 in the morning Central Time. It closes at 3 p.m. Central Time. And while the stock market is open, you have a bunch of buyers of different stocks and a bunch of sellers of different stocks, all congregating, electronically now on the exchanges and coming up with that meeting of the mind. I'll sell you this stock for $100. If someone else says, okay, I'll buy it for $100, then the price is $100. So it's this tug of war all the time between buyers and sellers. If you have a lot of sellers coming into the market, that's going to push the price down. If you have a lot of buyers coming into the market, it's going to push the price up. And so you end up getting a lot of ups and downs with prices. And in the stock market, we can see that change in price very easily. It's very transparent and the information is being pushed to us almost constantly. Stock prices are always changing because investors' expectations about the future are always changing. This is critical at this point in time in the market, and it's critical all the time, right? And I know we've talked about this in the past, that in investing, investors need to be looking forward, not backward. But even more nuanced than that, investors are looking forward and they're not as worried about what's happening today. So this can form a lot of disconnects with how we feel about where we are today versus how the stock market is reacting. So keep that in mind. We're looking forward and not necessarily looking forward one day or 1 week. Many times the stock market is looking forward 6 months or 9 months or 12 months into the future. So it's more predictive than a lot of people give it credit for, especially if you're a beginner. And for these reasons, this is why the stock market is, I'm going to say only, I don't say only a lot of times, but I really truly believe that the stock market is only appropriate for long-term investors. So this is not a, this is not a group, this is not a topic about day trading or making money fast or the next hot stocks or the next hot whatever. This is really meant to be stocks as part of your investment strategy for the long run. And I really, because of the volatility in the markets, the way the prices go up and down so far, so fast, if you're in it for the short term, it can be very dangerous. But the reason or the way we can get around some of that danger is by increasing our holding time to years or ideally decades. So this whole presentation is an eye towards how can you be in the stock market? How can you get in there for the long run? And stocks are a tool for wealth building. It's one of the asset classes that people can use and have access to that has the ability to generate a lot of wealth over time. And I really, really believe in the power of the stock market. And I really, really believe that the more people we have out there who are participating in the stock market and receiving its benefits, the better life is going to be for everyone. So I'm definitely a stocks for all type of person. But ultimately, the decision is going to be up to you as to how you participate and to what extent you participate. All right. So before we go any further, I apologize for those of you who have seen me teach this in the past, because I know that you've seen this, but I'm going to say it again because I can't help myself. So the underpinning of investing in finance is a concept called time value of money. If you took Finance 101 in college or in high school or wherever, it's the set of mathematical equations that describe and calculate compounding. So the idea that that money and wealth creates more money and wealth over time. So I'm going to kind of run through a few scenarios just to show you how this goes through under different scenarios. So let's start here in the upper right-hand corner where we have, let's just say we have $10,000 to invest. So we're starting with $10,000. That's our present value. Oh, let me back up. In time value of money, there's 5 inputs. The idea is that you come up with assumptions for 5 of them or 4 of them, and you solve for the 5th. So in this scenario, we're going to calculate something called future value, worth in the future. And we're going to do that by making assumptions for the 4 other inputs in time value of money, which are present value, what something is worth today, rate of return, which is how fast we expect our investments to grow on average, payment. In this scenario, I have payment as 0, but when you're saving money to invest, so this might be in your 401k, this can be a positive number. When you're in retirement and you're drawing money out of your accounts, this would be a negative number. So there can be money coming in and money going out of accounts. For this scenario, I've made it 0 though. And then number of years. So this is where the time value comes in, number of years. How long are we doing this? So in the upper left-hand corner, we have a $10,000 lump sum that we're starting with. And let's say we are choosing an investment that we expect to get a 5% rate of return over time on average. We're not going to put any money into this account, and we're not going to take any money out, so the payment is 0. And we're going to let this go for 10 years. If we come back in 10 years, according to time value of money, we should come back and our accounts should be worth $16,289. So that $10,000 has grown 5% per year and is now worth $16,289. We go over here to the upper right-hand corner, we have the same inputs generally. We have our $10,000. We have our 5% rate of return. No money going in, but no money coming out. But now we're gonna let it grow for 30 years. So if we plug this, am I freezing up a little bit? I'm just gonna give my computer a time to catch up. Okay, so if we're in the upper right-hand side and we're compounding for 30 years, we plug that number into our financial calculator, or you can build a calculator in Excel. And when we plug those numbers in, we come up with a future value of 43,000. Sorry, I'm trying to move my little screen here. 200 and something dollars that I can't see because my window is over the last 2 digits. But maybe I can make it smaller. $43,219. We go down to the bottom left-hand corner, we have our same $10,000 that we're investing, but now we're making a different decision. Instead of investing in something that we think will gain 10%, or 5%, now we're choosing an investment that we hope and expect will earn 10% per year on average over time. So when we plug these numbers into our calculator, after 10 years, we would come back and we would expect this account to be worth $25,937. So this should make sense, right? Because the example right above it at a 5% rate of return, a little bit over 16,000, if we get a 10% rate of return, we would expect to end up with more money, right? And we do. We end up with almost $26,000 over those 10 years. So now we go to the bottom right-hand corner, and we have our $10,000 starting value. We have our 10% rate of return that we're targeting. We have no money going into the accounts, no money coming out of the accounts. And now we're gonna let it grow for 30 years. When we plug this number into our future value calculator, this is usually, if we're in person or if we're in class, I would ask you all to guess, to make an estimate as to what you thought the future value would be. Typically, the guesses that I get are something like $100,000 or $90,000, maybe $120,000. But when you plug the numbers in, you end up with $174,494. Very few people forecast or estimate this amount. And the reason I show this example almost every time I talk is because this is the secret that wealth building people understand, that people who aren't exposed to these concepts don't necessarily understand or just have never been exposed to, which is exponential growth, compounding, time value of money. That given enough time at a high enough rate of return, this is how normal people can create a lot of wealth by investing in the types of investments that grow at higher rates. It does mean, and we'll talk about this, it means taking risk, and it means exposing yourself to volatility and really scary moments in the stock market. And we'll definitely talk about that going forward. But the other takeaway here is if you can't quite get to the point where you are able to take some risk with the expectation that you will get a higher rate of return and end up with more money, you need to save more money. Because to fund retirement, that's usually what this discussion comes back to. It's something like retirement or saving for your kids' college. You need to have a nest egg in order to fund that. And the nest egg needs to be a certain amount so that you don't run into the risk of running out of money. So while there's a risk in being in the stock market and investing in risky asset classes, there is absolutely a risk of involved with not targeting a high enough rate of return, not taking risk now, because there's a chance you might not have enough when it comes time to retire. And that looks like a lower standard of living. It looks like working longer than you want to or potentially can. So having more resources under your control will lead to more safety down the road. Again, this is kind of the purpose of this group, is how do we create wealth? This is the stock market, it's one tool, right? But this concept of wealth building can be used in different ways. So that's why I always go through this example, just to make sure everyone is aware of how time plus higher rates of return can grow $10,000 into almost $175,000. And so I'm happy to talk about compounding at the end if you want to come back and ask more questions about it, unless there are some already in the queue now. But it's a really important concept that I didn't want to skip because it goes hand in glove with why we invest in the stock market. All right, I'm going to keep going then. All right, so risk versus expected return. We just went through the scenario analysis where we looked at a 5% annual rate of return versus a 10% annual rate of return. So where do those numbers come from? This is a really cool chart, updated to, almost to the present day, updated through August of 2020. And so what we're looking at here is a chart that's showing, it's mapping our compound annual return, which is on the up and down axis, right? That's the y-axis. That's our compound annual return. So that's our R. It's in a percentage. So that's where that 5%, 10% number comes from. And then on the x-axis, going along the bottom, we have something called standard deviation of annual returns. And that's also a percentage. This is a measure that we use in finance to describe volatility. So it's how we're describing how far do actual performance numbers, how far away are they from our long-term expected rate of return number, which is about 10%. So if you look at the diamonds in the upper right-hand corner, you have these 3 black diamonds, and one of them is large US stocks. This is the S&P 500. Up there is also real estate, which is commercial real estate, not your house, even if you're living in Austin. This diamond is describing commercial real estate and investing in it through something called a real estate investment trust. But just like stocks, commercial real estate goes through these kind of boom and bust cycles. And so it's a high risk, high return asset class. Up there, we also have small US stocks, so smaller companies that we can invest in. In the bottom left-hand corner, we have aggregate US bonds. Let me see, maybe I can have like a little spotlight in here. So aggregate US bonds here. Bonds is a lending relationship. So if you lend someone money, they promise to pay you back plus interest. That's a different type of investment than being in stocks. It's lower risk, but lower return. And same thing with cash. If we consider cash an investment, which is, I mean, it's on the chart, so we'll consider it an investment. The idea, it's very low risk, right? Because of that FDIC insurance that you can get. But in exchange for taking basically no risk of losing any money, you are compensated with low rates of return. This time period is from 1994 to August 2020. So it's over a long period of time. I mean, I think that by now we all know that the rate of return on cash, like our savings accounts, checking accounts, high yield savings, CDs, money markets, those types of investments is way closer to zero, if not zero right now. But over time, you know, sometimes interest rates go up, sometimes they go down. The whole point is that over long periods of time, you can expect cash to be a low risk, low return asset class. So the 5% number comes from kind of this choice to invest in less risky assets like bonds and cash. And the 10% number comes from this decision to invest in riskier asset classes, which is stocks and commercial real estate. In here, we also have gold. That's interesting to look at during this time, right? Gold is kind of in the middle of these things. You know, it's higher risk than cash, lower risk than stocks, but with a lower expected rate of return. I'm not going to spend too much time talking about gold unless there are questions after class or after the session. And non-US stocks. So these are companies that are based overseas. From a US investor's perspective. You know, most of this, all of this really is going to be from a US investor's perspective. Any questions on that so far?
It looks like I see Jeannie has her hand up. Can we unmute you? Oh, there you go.
Wow. Okay, so they always say be diversified, have international stocks. I had no idea that non-US stocks had a 4% rate of return. That's just astounding.
Yeah. Yes, so this is, what you learn in investing is exactly what you said, right? Just have a diversified portfolio. There are periods of time where international stocks and or assets that are denominated in non-US dollars do better, right? I think what I take away from this chart, though, showing this time period from 1994 to the present, is that a case could be made that you would want to reduce your overall exposure to international stocks. That is not a recommendation, right? This is not investment advice, but I think it is interesting to see that on this chart. Like you said, if we're all in target date funds and we're all in our diversified portfolio, what is the role of international stocks? I mean, in the past, it's been, and you know, this is where you still could make it, that in the future, the rate of return will be higher than it's been in the past. Because if you go to places like China and India and places where they have growing middle class, so you have a bunch of people kind of coming up in wealth, that would be good for market returns in those countries, be one of the cases for investing in international stocks. But I mean, I will definitely agree with your point that it's interesting to kind of see it mapped out here and see what the role of international stocks are in a diversified portfolio.
Thank you, Sarah.
That's a great question.
Thank you.
Great. Any other questions on this risk versus return? I mean, another thing that, you know, that I hope it shows is that these things are related, right? Like they're related because they have to be in the financial system. No one would expose themselves to the volatility of the stock market if there was not a pretty good expectation, not a guarantee, but a very strong expectation that eventually you would be compensated with higher rates of return. So that's what this chart is showing over time. All right. Let's keep going then. We can always come back to any of these slides if y'all end up wanting to talk about them more. Oh, how do I get this off? Sorry, guys. Now we're going. Okay, hold on. Let me see if I can figure out how to erase this eraser. That'll help. All right. So here we have a chart of the S&P 500, which is a basket of large US stocks. So 500 very large, well-known US companies. If you put them in a basket, which S&P, Standard & Poor's does, and you calculate the cost of the basket of stocks, that's what this chart is showing. That's what the S&P 500 index is. So if we look at a basket of 500 stocks going back to 1950, I mean, this is a really, really long-term chart showing what the returns have been over that very, very long period of time. So if we start with, again, going back to our time value of money calculations, if we start with what the price of this basket of stocks was in 1950, the S&P 500 was at 1729. As of yesterday, probably, it was 3,115, right? 116 almost was the price of this basket of stocks. So over time, companies in the US, the economy has grown. Companies in the US have grown, some have died. There's been kind of a creative destruction process. But in the aggregate, the value of 500 well-known US companies has grown to 3116. Calculate that over about 70 and a half years, our compound annual growth rate is 7.65. If you add on top of that, that many of these stocks, right now about 400 of the 500 companies in the S&P 500 also pay a dividend, a cash payment to shareholders. If we add another 2.5% on top of this 7.65%, we come back to that long-term annual growth of 10. And so that's what this is showing, the long-term upward trend of the market. Now, most of us probably don't have 70 years on our investing time horizon. But conceptually, the longer you give the stock market to work itself out, the better the chances that you're going to make money in the stock market. The shorter your time horizon, whether it's day to day or week to week or quarter to quarter, the more likely you are to experience in a negative way all of these bumps and ups and downs that you see throughout stock market history. Like, that's just what the stock market is. It's a, you know, it's a volatile place to invest, especially if your time horizon is very short. You know, up here in the upper right-hand corner, we can squint and we can see March 2020 up there, right? A pretty sizable correction, but now we're back to almost where we started at the beginning of the year, which is super interesting. All right, if we keep going. Oh, yes.
There's a question about if you could talk about this graph and consider inflation.
Yes. Oh, great question. Thank you for the inflation question. These numbers are nominal rates of return. That means not including inflation. So you can adjust nominal rates of return for inflation. You take your nominal rate of return, in this case, let's say on a combined basis, it's 10% over this period of time. So a 10% nominal total rate of return. Then you subtract out what inflation has been over the same time horizon. I actually don't know what it was, what the average inflation rate from 1950 to the present is, but let's say it's 4%. You would take your 10% nominal rate of return, back out the 4% that is attributable to inflation, and you're left with something called your real rate of return. So in my example, which I'm just making up the numbers right now, is a 6% real rate of return. And you can do that with every asset class. So let's say over some period of time, bonds return 3% per year. And inflation over that same time period is 2% per year. You might get a real rate of return of 1. So that's the rate at which your wealth is actually growing on top of inflation. Stocks are actually a really good inflation hedge because companies have all of this flexibility to adjust their pricing to account for inflation. So you would expect stocks to do better than bonds or safer asset classes if there is inflation in the system. I mean, I think the most extreme example of this that will resonate with people is if your rate of return on cash is 0 and inflation is 2% per year, you're losing 2% per year, right? Your real rate of return is -2. So even something that we consider to be without risk does actually have risk, just from a different place. Instead, you know, cash is exposed to inflation risk, the risk that your dollars are buying less and less over time as inflation pulls up away from you. So thank you for the question. These are nominal rates of return, I think pretty much throughout the slide deck, but you can always go back and adjust for inflation over whatever time period you're looking at. Great question. Anything else for now, Gwen, or should I keep going?
Oh, there's a follow-up question of that. Can you explain what you mean by stocks are good inflation?
Stocks are a good inflation hedge. If you are concerned about inflation, you need to be targeting investments that have the potential to grow more than inflation. If you think inflation will be 3% per year for the next 30 years, you need to be targeting investments that have potential to grow by at least 3% per year. That excludes a lot of investments, the main one being cash, right? Because cash at 0%, there's no mathematical way that cash will keep up with a 1 or 2 or 3% inflation rate. Stocks over time, in the past, throughout history, have generally returned, it's something like 5 or 6% over the rate of inflation. Again, it's because the companies that you own with stocks have the ability to adjust for different inflation environments. And it's not a law. It doesn't have to happen that way. It has just tended to happen that way. So I don't know, hopefully that helps. A lot of people talk about gold as an inflation hedge, right? That if you are worried about inflation, you should invest in gold. If you are worried about inflation, you should also really, really consider investing in stocks, because over time, they have also been able to grow faster than the rate of inflation. Really good questions. Awesome. All right, we can definitely come back and talk more about inflation or about this chart. I'm going to kind of just keep going so we can have a chance of getting through all my slides. All right, so here I'm showing, as investors, what you're doing is you're trying to allocate your resources and balance safety, right? Most of us need some amount of safety in the short term because we need to pay our bills, right? We have things that we need to do in the short term, but we also need to be thinking about the long term. Again, because most of us need our investments to grow so that we end up with enough when we get ready to retire. Most of us aren't in the position, either our incomes aren't high enough, or some other reason where you can't save your way to the ending nest egg value that you need. So most people really need their investments to do some of this heavy lifting for them. So we're trying to balance these two things, safety in the short term and growth over the long term. So this is just a chart showing, the two major choices that you really have. Do I invest in stocks? Do I invest in bonds? I know that there are other choices, but I'm just going to boil it down to those two. Do I invest in stocks or do I invest in bonds? So this chart is showing US stocks versus US bonds since the beginning of the last market crash that we had. So the chart goes back to the beginning of 2007 and shows kind of what you can expect over long periods of time between these two asset classes. We can see that the bond line, the blue line, is relatively steady. It still goes up and down a little bit, but relatively steady, but doesn't grow very much from the beginning of the day, right? So it's slow and steady. The stock market, at the very beginning of our time horizon, the stock market's up and then it falls 50%, 53-ish% because of the last financial crisis, the housing market induced financial crisis. Then eventually the stock market recovers, it climbs and climbs and climbs. It takes a long time to get back to where it was at the beginning at 2007, but eventually it gets back to where it was, and then it continues to climb to today. So over this time horizon, if you had started investing in 2007 and you fast forward to 2020, your stock investments would be up over 145%, whereas your safer investments have gone pretty sideways. On a price basis, they're only up about 19%. Most of us need to be closer to this green line. So you obviously have to know and acknowledge and be mindful about the path that the stock market might take on its way to these highs that we expect in the future. As we all know, going through 2020, going through 2008, 2009, back in the day, the path is uncertain. The market might go down and then go up. It might go up and then go down. It might go sideways for a long time and then go up or go down, right? But over long periods of time, you can imagine a future where the stock market is higher than it is today. We don't know if that happens over the rest of the year or 5 years or 10 years. But as we get into the 10-year time horizon, it doesn't take a huge leap of faith to think that companies are going to create goods and services that people want to buy, and that owning those companies would lead to more money 10 years from now, and certainly 20 years or 30 years from now. So that's, again, like how extending your perspective from the rest of 2020 to, well, what happens in 2025 or what might be happening in 2030 will really benefit you as a stock investor. And just one more, just on that point, volatility, meaning the price change in the stock market from day to day, that is the price of admission for participating in this asset class. It's why you get the extra 5 or 6% above and beyond inflation. It's because you have to take this painful path, right? You don't get to take the smooth line up to a 10% rate of return. You have to go through all of these ups and downs. So on this chart, the black line is the price of the S&P 500. The red line is the S&P 500 index daily percent change. So how much does the stock market change during one day? And so you can see here that there are plenty of times over and over again where the stock market is volatile, right? I mean, and then in 2020, we had this ridiculously extreme period of volatility where on one of the days in March, the stock market fell by 12%, right? Most people have a really hard time getting through that, and it's completely understandable. And it's important to know and acknowledge that it can happen, right? Like, so now we can see, like, it's not uncommon for the stock market, the price of the stock market to change by 4 or 5% in one day, right? And that's really scary when that happens. But if you remember that that's why you should expect a higher rate of return over time, hopefully that gives you some evidence and some reason to stay in the market instead of bailing out when things get volatile. So I just wanted to show this chart. I mean, the 12% and the 10% changes that were happening in March were extreme, right? And very painful to gut through. So it's just how the stock market works. Just because the market falls by 12% too doesn't mean you need to sell, right? It might mean that you call someone or you reach out to someone to kind of check yourself, but it might mean that you're upset or you're sad, but it doesn't mean that you have to sell. These things, this is how the market is going to continue to be, just probably for the rest of everyone on this call, the rest of our investing time horizons. Any questions on this or this idea? Certainly, I don't want anyone to walk away with the idea that being in the stock market is easy. And I think I've made that clear over the however many years that you guys have listened to me give this spiel. So I just want to make sure that we're all very clear on that. It's not easy and it's not smooth. All right, we'll kind of keep going here. Another thing that's coming up with the stock market, and this happens all the time, and it's just a natural, it's just what we naturally gravitate to, is trying to predict where the stock market is going to go. Can you predict where the stock market is going to go? My very, very strong opinion is that no, you can't. So this is a chart that, I'm sure some of you have seen a whole bunch. I showed it in my classes, I show it here. What are all of these crises that have popped up going back to 1957. You can look at all of these really bad things that have happened, all these really severe times of uncertainty. We have stock market crashes, we have wars, we have other epidemics, right? We have all of these things that have happened. The stock market, I really firmly believe the stock market as a collection of companies finds a way finds a way to exist in whatever environment it finds itself. That makes the stock market unpredictable because it doesn't always act the way you expect it to act, right? I mean, 2020 has been like case in point there, right? So I would get away from trying to predict how events are going to impact the stock market. I would just really try to sidestep that desire altogether, because no one does it well. And even if you get lucky one or two times predicting something, chances are very good you won't be able to do it on a consistent basis. So, you know, the alternative to doing that is just you stay in the stock market and you acknowledge that things are out of your control in a lot of ways, and you give the stock market time to work itself out and to adapt to whatever environment it's in. That's my really strong opinion, especially for people who aren't professionals, because if you are trying to predict the markets in addition to whatever's going on in your real life, you're setting yourself up for a lot of anxiety and a lot of not getting it right, which can cost you money. So just wanted to show this for everyone. I've been showing this for a really long time too, right? Just kind of like as some of these things were happening. I started teaching my classes back in 2011, 2012. So we've been looking at all of these little things that have been popping up you know, over that period of time. Those concerns, the next crisis is always coming too. So there's never a point in time, if you start getting into the habit of trying to predict crises, they never stop coming. There's always something else that could happen or could be bad. It never stops. There's never a point in time where you look around and you're like, I think that everything's fine. There's no problems in the world, no problems in the US, no problems with companies. I pretty much know how this is going to play out. It's never going to happen. So it's a dangerous trap to fall into, trying to predict what is going to happen. I say all that, but my next slide is about trying to get some visibility as to what might happen right over the next, in the short term. I really truly use this as like a way to explain and show insight as to how the stock market might be thinking and why it might be doing what it does, and not with an eye towards getting people to get in and out of the stock market. So I just, you know, I want to be clear about that, you know, if we're looking into the future, you know, I just said, like, you shouldn't try to predict what's going to happen, right? But we're looking into the future and trying to come up with some like, what can we expect going forward? So here on the next couple slides, this is something that we did back in June 2019, for those of you who are at that meeting in Austin. And we did it again in February 2020. Hopefully some of you were there in February 2020. We looked at like the bull case and the bear case for the stock market, and it's really interesting to go back and look at it. A lot of these things that are on these next two slides, we talked about in February, and we talked about in June of last year. And it's my very strong opinion that we're going to be talking about this the next 6 months and the 6 months after that. So I'm just going to kind of go through these slides and give you some ideas and some, hopefully what I think are insights into how the stock market works. So the bullish case for stocks. Bull means that the price is going up. So the bullish case for stocks means what could lead you to believe that the stock market might continue to go up even after it's bounced, 50% or whatever the number is off of its March lows. What could cause it to continue to go up? So if I was making the bullish case for stocks and saying like it could continue to go, they could continue to go up, then I would say, okay, the US economy is rebounding, right? Better economic news is coming in. Now it's off a very low base. Like the economic news coming in from March and April and May was the worst on record in a lot of cases. And so it's not saying much if things are better off of super dramatic lows, but that would be one thing I'd be saying, that the economy is recovering. A coronavirus vaccine, right? There's always news about who's coming to market, what does the timing look like on that, how many people can get vaccinated. that is very much driving people's perception of whether or not they should be in the stock market right now. I have in bold here the idea of don't fight the Fed. This, I think, might be one of the more important reasons to be constructive on the stock market. Maybe, you know, if it's not going up by a whole bunch, not falling by a whole bunch in the future. So I'm just going to talk about this for a second. The Federal Reserve is, it's our central bank. It's the United States central bank. The Federal Reserve is in charge of monetary policy. So that really means that it's in charge of setting interest rates. It's in charge of making sure the financial system works and money gets to where it needs to go. If you think about money as the blood in the circulation system of an economy, if money doesn't flow through the economy, if people don't get paid what they're expecting to get paid, and that money doesn't flow through, it causes very, very bad things, not only in a financial system, but in an economy, right? Like if you are running a business and someone doesn't pay you what you're owed, it's very bad, right? So the Federal Reserve has a lot to do with that. They have intervened in a major way in the bond market. And that, again, just to kind of go back to a couple slides ago, that's companies and people lending to each other. You know, if you lend money to someone, you want there to be some certainty that you're going to get paid back. So these are all things that the Federal Reserve has a very heavy hand in since March 2020. And they had a heavy hand in it before that, but in March 2020, the Federal Reserve came in a major way and just said, listen, we are going to make sure that the financial system does not fall apart here, because if it does, people are going to get hurt. So the Federal Reserve brought in lots of support, and that has flowed through to support for the stock market. It's support for a lot of different things, but it has flowed through to support for the stock market. On kind of the other side of that coin, you know, my next bullet point is Congress and federal and fiscal stimulus, right? So that's all these stimulus packages that have been coming through, like sending money to people, providing backstops for people. That is all authorized by Congress. That, you know, in a similar vein, is pushing money into the system. And I really believe this. I might be naive in this, but it's to prevent people from losing jobs and falling into poverty for something that they didn't do, right? People didn't do anything wrong. And so Congress and the Fed together really made this effort in March and April and May, and since then, to insulate as many people in America from the fallout from having to close the economy down. So that's still there. That's still a support for stocks. Fewer companies will fail if consumers have money in their pocket and are still going to HEB and are still, you know, spending money on home improvement projects and all of those things. If that dried up, you would expect the economy and the financial markets to go another way. The other major thing here is corporate profits. You know, that I think a lot of people expect that the profits that companies can generate will be better next year and the year after that. And so going back to the stock market being forward looking, in a lot of ways, investors are just skipping 2020. Everybody's, you know, not everybody, but investors are saying, yeah, we know that 2020 will be bad. We got it, right? We know that there's going to be bad numbers that come in, but what about 2021 and 2022? If you're optimistic about the future, then you might be more willing to buy stocks instead of hunkering down in cash or something safer. So these are some of the things that I would say if I was making the case that the stock market will go up or continue to go up in the short term. So I just wanted to kind of point out those bullet points. I'm going to go through my bearish case too, and then leave plenty of time for question and answer. And certainly, I mean, I don't want to give anyone the impression that this is a science, right? It's not. It's the financial markets are so complex that most of the time you don't know why things are acting the way they are. So we're just kind of looking for evidence and looking for trends that can maybe lead us down the right path. Am I in the market? Am I not in the market? So the bearish case, a bear market is when prices are falling. So we just recently had the fastest bear market on record in March 2020 when the market fell something like 34% in, I mean, it was something like 3 weeks or 4 weeks. And that was very, very fast. Typically a 20% up indicates a bull market and 20% down is a bear market. So again, it's not a science. But if I was making the bearish case for stocks and I was saying, okay, we should be cautious, there's things that are happening that really could impact what people are willing to pay for stocks or how valuable companies are. The first bearish case that I might make is like, hey, the stock market has rebounded to all-time highs, even though the economy is still weak, right? That there is like this disconnect with how the numbers are today versus how optimistic people seem to be being in the stock market. And that's not sustainable unless the economy gets a lot stronger. So that would be one thing I would say. The second one here, going back to how profitable do we expect companies to be over time? People might be expecting profits to rebound by too much. They might be overly optimistic about what profits will be going forward in 2021 and 2022. And that kind of goes hand in hand with the next one. Recovery expectations are too optimistic. Coronavirus, hey, it's still here, hasn't been solved yet, right? So if that takes longer, if we're being overly optimistic about what a vaccine looks like and how quickly people can get back to work and some sense of normalcy, get our kids back to school, that could certainly make a bearish case. What if the news that starts coming out is disappointing as far as a vaccine goes, instead of people thinking like, oh, maybe it's September, or maybe it's December, or January, or April at the latest? What if the results start coming back like, oh man, this is harder than we thought. It's gonna be longer than we thought to get a vaccine to market. I put a bold on politics, right? Because I think that that's probably what's on everybody's mind. What I will say, like again, my strong opinions here, politics in and of themselves, and I'm talking about which party is in office, generally does not have a huge impact on the stock market. There's a bunch of, and I'll send a link to a couple articles that I have that look at stock market performance over different administrations. There's not that big of a difference. And generally speaking, over an administrative period, the stock market tends to be up, right? So kind of the tax policies, healthcare policies, like all of those things, that goes back to this idea that the companies in an economy will figure out how to operate in whatever environment they're in. And if they don't, they fail and are replaced by someone else, right? So politics in and of themselves, I don't think should be a decision maker as far as do we expect the stock market to go up or down in the long run. But in this particular moment in time, I do think that in the short term, with the elections in November, if there's a question as to who the next president will be, with emotions being as high as they are, and that trickling through to a Congress and maybe a Federal Reserve not able to provide some of the support that we just talked about, that could be tough for the stock market to digest at the end of this year into the beginning of next year. So it's kind of like if there's some sort of situation that from like 2000, right, where you had Bush and Gore trying to figure out who the next president was going to be. If there's something like that, and we're in the middle of what could still be a recession or something, just coming out of a recession, and kind of that support provided by Congress and the Fed would maybe be questioned because we don't know who's in charge here. That could lead to short-term volatility. It certainly would lead to short-term volatility if those things actually happened. And then I kind of want to skip down to the bottom to the rise of the Robinhood investor being the bearish case. And I guess this could go either way, the bullish case or the bearish case for the stock market. There's evidence. I mean, there's evidence that a bunch of people who had never participated in the stock market before are opening accounts with Robinhood, like the app on your phone, and just putting their stimulus checks in there or any money that they saved in there and just plowing it into stocks and companies that they recognize without really maybe understanding exactly what they're doing. The reason this might be bearish is I think if you have a bunch of people new participants coming into the market and bidding up the price for things, you want to think through, okay, well, what happens when the market, inevitably, the market goes up and down, right? What happens when the market falls? Are these people sticky investors? Are they willing to stick through the market, through the ups and downs? Or is this more like gambling? Or is it more speculative or kind of get rich quick type? And if that's the case, if that type of investing through Robinhood, because it's, it's a lot like a game. I think a lot of people are treating it like a game. Will those investors, will they pull out when there's the next sign of danger? So that would be, that's just something I don't really, I don't know, because it's never really happened before. You have a lot of new individual investors coming into the market. And I think it's great because you guys know that I love talking to individual investors about the stock market, but it does make me really, really nervous when people's perspective is very short term and when people treat it like a game, because it's not. So I just talked for a really long time. I'm assuming that there are some questions on some of these bullet points. And I do have some charts to show you with some more detail too, but I'll stop for a second and see what has popped up.
So we've actually had a question kind of circling back to politics. And Don is asking, don't elections and the results of elections have a historical bullish case for stocks?
It's if you look at, you could Google something called, what is it called? Like the presidential cycle or something about like the years of a president's administration. And there is some like really interesting data there, like that. Generally speaking, the stock market, if we're thinking about the aggregate, the stock market doesn't like uncertainty, right? So right now, no one knows who the next president is going to be, but hopefully, fingers crossed, right, on November 4th, we will. Regardless of who it is, just the fact of knowing who it is can be bullish for stocks, right? Regardless of what the policy implications are. And so there is, like, if you go back and look at all the different first years of a presidential term, there is some evidence to suggest that, okay, the stock market can do well in the first year because that's the year that the president and the new Congress roll out a bunch of policies and really stimulate the economy, and that flows through to the markets. So I think if you wanted to go down this road of seeing how politics specifically impacts stock market cycles, there's plenty of resources out there if you start digging. I think that my main point, and to be clear about this, what I would really, really caution against is making a decision about being in or out of the market based on who wins the presidential election. Because people do that, right? People say, I don't like this person, so I'm out. Or I do like this person, so I'm in. And they make it personal or more political than it should be. The stock market is apolitical. It doesn't, it's really, really dangerous to make investing decisions based on who wins an election. Does that make sense? I know people can, certainly I would expect there would be people who would argue with me on that, but I don't think there's a lot of evidence to support that one party over the other party is better or worse for the stock market. Does that answer your question? I know I'm talking to everybody on mute, so I'll just, if you have a clarifying question or a follow-up question, we can certainly circle back to it. It's a really good question and very timely.
Donna says yes, perfect.
Awesome, thank you. Anything else, Gwen, or should I keep going?
I think we can keep going for now.
All right. Okay, so we're going to talk a little bit about one of these bullet points. The bullet point that I have in both of these, which is about corporate profits, or corporate earnings, profit estimates. I'm going to kind of hone in on that a little bit. A lot of you have seen this before, so we're going to go through it again. Because as we're talking about the stock market and what the stock market is, the stock market is really a reflection of how profitable companies are. Remember from the very first slide, stock market, owning stocks is owning a company. As an owner of a company, what you're the most interested in is how many profits are left over at the end of the day, or what amount of earnings are left over at the end of the day. So I want to drill down on this just a little bit because I think it'll be helpful understanding the markets going forward. So here I have a very highly stylized income statement. An income statement is one of the financial statements that companies that are publicly traded, like the ones that we can invest in, every quarter a company puts out its income statement, which is also known as their profit and loss statement, their statement of income, their P&L. So there are some different names for it, but the main gist of the story is this is where the company tells you what happened last quarter as far as profits go. So at the very top of an income statement, we have revenue. Revenue is also known as sales or the top line because it's at the top of the income statement. The revenue number is where we get an idea of how much in goods and services did this company sell last quarter or last year. You know, every company, it's taking money in, and so that money is put in this revenue bucket. You know, if you go to the Apple website or you go to an Apple store and you buy an iPhone, Apple puts that $1,000 thing that you bought, that money, into the revenue bucket, and then they disclose it every quarter. So revenue is important because that gives us an idea of what the dollar value of the goods and services are that a company is producing. Then, you know, for every company you bring money in, but then money flows out of the company. So the first line item we'll talk about is something called cost of goods sold. So how much did it cost us to make the thing that we're selling? You know, you have to pay your suppliers, you have to pay for raw materials. So there's a line item for that. So cost of goods sold, you have to pay for the stuff that went into what you make. The next line item that we have here is operating expenses. You know, this is there's lots more detail underneath operating expenses, but this is basically, these are the costs that a company incurs to keep the lights on and to continue being a company. So you have to pay your payroll, right? You have a bunch of people you need to pay. You have to pay their benefits, you have to pay rent and for software and utilities and all of these different things in order to continue being a company, right? If you stopped paying your people and all of your people left, then you wouldn't have anyone to do the work of being a company. So operating expenses flow out the door. Interest, if you've borrowed any money, the company has to pay interest on money it's borrowed, and taxes. If there's money left over, then you have to pay your taxes. After all of those things get paid, hopefully something is left, and that's what's called earnings. So also known as profits or net earnings or net income, and also known as the bottom line, right? Because it's the bottom of the income statement. This is the number every quarter that the stock market is looking at and anticipating and trying to forecast, right? What will this company's earnings be this quarter, and what do we think they will be in the future based on what they are now? We're just getting towards the end of earnings season. So kind of in July, we got all of this information from different companies, and we saw some companies making a ton of profits, right? And we saw a bunch of companies losing a bunch of money, depending on where they are and what business they're in. But this number this earnings number is what drives the price of a stock and what drives the price of the stock market, or a big collection of stocks in the aggregate over long periods of time. So the earnings and the profit numbers are really, really important. So now that I've kind of really quickly explained that, I'll show you this next chart, which is one of my favorites. So we can look at that. We can look at this relationship between price. So that's that S&P 500 number. That's what, now at 3116. It's the number that when you watch the financial news, they say, oh, the stock market was, the stock market hit all-time highs at, 3,200. The black line is that number. So the price of the S&P 500. So that's the black line. The red line are the profits or the earnings that those 500 companies actually produced. Every quarter, the companies tell us what their profits were. So S&P, Standard & Poor's, or anyone really can keep track of the earnings numbers and add them up for us. And we can now look at this chart that shows the relationship between those two things. So if you're wondering what drives the stock market over long periods of time, it's earnings. Are companies making money or are they losing money? So here, and this goes all the way back to 1988. Again, we can see the red line, which are the earnings. You can see that it's cyclical, right? There's market cycles. There's times of expansion and times of recession. We would expect that to continue throughout time, right? We just kind of have booms and busts. That's just has been what the nature of our economy and our business cycle has been like. And then the black line, most of the time, has this pretty tight correlation with the red line. We can see back here during 2000, this is like the 2000 time period. This is the dot-com bubble. And this is what a bubble looks like, by the way. A bubble does not mean high prices. A bubble means the price of what you're buying is way too high based on this fundamental underpinning of why you own the asset. So in real estate, it's rents, right? If the price of real estate is way higher than the rents would justify, then you would be in a real estate bubble. Here with the stock market, it's earnings. So back during the dot-com bubble, we can see that black line really started pulling away from the red line. And eventually that corrected itself. And the stock market fell by 50%. If we zoom out to where we are today, the red line is where earnings were last year, 2019 earnings. That's kind of where our red line stops here. This first red box is kind of the current guess about what S&P 500 earnings might be for 2020. And then out here, these red boxes are predicting the profits for the future. So this goes back to, if you think profits will increase in the future, you might be willing to pay more for stocks today, even though the economy is not strong yet, right? Or maybe that some of these companies aren't strong yet, if you think they will be stronger in the future. So the black line here, we saw the price decline in March 2020 as the economy was shut down, as the country was shut down, because everybody knew that, okay, if nobody's going out anywhere, nobody's spending money, a bunch of these companies aren't going to have revenue coming in, so they won't have profits, and some of those companies will fail. And it's all happened so fast that nobody really had any idea of what profits might look like in the future. And when you don't know, or when you think that it could be incredibly, incredibly bad, people kind of in the short term will sell, right? And there were other technical reasons, I think, that the stock market, that the sell-off was so bad. But once things stabilized, and once the Federal Reserve came in and provided support, especially for the banking system, and once Congress came in and provided support for small businesses and consumers, right, regular people, by sending out checks to people, people kind of took a step back and started thinking, with a little bit more information, okay, like if things don't completely fall apart, how quickly can they get back to some semblance of normal, right? And it's not that the future will look like the past, it's that there are companies that are making money, right? Investors also pivoted pretty quickly to looking at the companies that already make a bunch of money and companies that have a lot of cash on their books and not very much debt. And that has led people to really kind of the largest companies in the world. So like Microsoft, Facebook, Amazon, Google, right? There's a lot of, especially big tech companies, but also companies like Walmart, and Target are in good financial shape. And they also happen to be in the business of selling things that people want during a pandemic. So the market was figuring all of this stuff out, right? And it's still trying to figure all of this stuff out. And the market rebounded, a lot quicker than anyone expected. So that, the question of like, well, why has it come so far so fast is kind of important, right? What I think is the lesson to take away from 2020 comes back to stocks for the long term. That it's okay to ignore the stock market when it's crashing if you don't need the money right now, right? You can ignore it because we don't know what's going to pop out the other side. In this case, this is a classic, we call it a whipsaw, right? Market fell really fast and then it bounced back really fast. And it was really easy for people who were trying to understand what was happening and make short-term investing decisions to always kind of be caught flat-footed or caught on the wrong side of that decision. Because in March, everyone remembers this, right? In March, it felt like the world was ending for a lot of people. And it was really hard to stay in the stock market while prices were falling so fast. But now there's kind of a new perspective. Like now, people can see like, okay, the Microsofts of the world are going to benefit from this and are going to end up making a lot more money. So we want to buy stocks like that. And that has been driving the overall recovery in the stock market. I'm going to stop there and see if anyone has questions there. I am just before I stop, like these red boxes are guesses, right? They're forecasts. And they're always moving and being readjusted based on the new information that we're getting every day. So they're not, they're guesses. Any questions?
Yeah, Sarah, could you go back to the previous slide? When you're talking about the top line, is that the same as above the line expenses? And likewise, is the bottom line the same as below the line expenses?
No, because the way I'm interpreting the question, that's more of a tax question. And this is corporate finance. So I think they're in different realms of the accounting world. This is a little bit different. It's a lot of it different. This is how companies describe to investors how money has come in and gone out of the company. But it doesn't have a whole lot to do with taxes, other than telling you how much they owed in taxes.
Another question is, so EPS or earnings per share seems to be easy to understand, but what about EBITDA, which is earnings before interest, taxes, depreciation, and amortization? Some people say reflects more of a real picture of a company's stock price.
Yeah, some people use EBITDA versus earnings per share. I would say it depends on the industry. In certain industries, it will make more sense to look at EBITDA versus net income. So yes, but not for all industries. And most people, if you're really doing like a hardcore analysis of a company, you probably look at both. And so it's kind of like the next step to doing financial statement analysis or securities analysis if you're trying to value a company. For these purposes, these slides are more for people to make the connection that the amount of money that a company makes will have a very, very strong impact on whether the price of that stock goes up or down.
Yeah, another question is, this is a great question. If we're in a bubble now, would it be better to wait to buy into the market?
I mean, so there's, if we are in a bubble now and there's some way to know that, then probably yes. But that making a decision based on that means you have to believe and have evidence that we're in a bubble and that the bubble will burst. I don't know if I'm quite there yet on the bubble talk, because there's so many unknowns, right? And it's I can see the argument either way, that prices are irrationally high based on what profits might be in the future. But I think and this kind of goes back to kind of a more, if you're concerned with valuation, like with using the PE ratio or the PEG ratio, things like that, I think, again, it's like the uncertainty around earnings is a really good question for the stock market in the aggregate, if we're talking about the S&P 500. But there sure are a lot of companies whose earnings are growing, and probably growing with a pretty good amount of confidence and amount of predictability. And so I'm talking about the very largest companies in the world driving the market higher. There's a reason those companies are so valuable, and it's because they generate so much in earnings. So again, like if you knew that the stock market was in a bubble right now, I mean, that's a big if, right? That's a big, that would be a big assumption to make or case to make. But if the answer is yes, that the market is in a bubble, then certainly you would expect prices to come back down once earnings don't meet the expectations that are set in the market.
Yeah, and then the last question for now, I think that's a good segue into it. Should you review the income statements quarterly of each of the stocks you own to determine if you should continue to hold or sell?
I mean, I don't know. This is like for individual investors, it's, how much time do you want to spend on this? I certainly think that once you start going into the world of owning individual stocks, you probably need to pay closer attention to that company's business, right? Because the reason you would choose to own one company over a basket of companies is you expect the one company to do better. And if that's the case, I mean, you should be keeping an eye on it to make sure that the reason you're continuously choosing to own one company over a basket of stocks still holds. But I do also think that there are certain companies that are probably so strong and so entwined in the fabric of our economy that if you don't mind that at some point, like the prices are going to go up and down and you're in it for the long run, you probably don't need to keep a super close eye on it. Really good question. Do we have any else, Gwen, or should I keep going?
I think we can keep going for now.
Okay. The other one, I love this chart. And this comes back to me teaching some version of this slide deck for many, many years. A lot of times investors psych themselves out by not wanting to invest at all-time highs. And so I just kind of brought in this chart. I think this chart is so interesting. So this, again, goes back to 1950. And what this is showing is the amount of time that the S&P 500, so the stock market in general, the amount of time that the stock market spends like at different price levels. So this green, the green on the chart is showing when the stock market is within 1% of its all-time highs. 37% of the time, going back to 1950, the market is within 1% of its all-time highs. That seems ridiculously high to me until I look at this. I'm like, oh, well, it's just the math of it. But if you take the stock market price being within 1 to 5% of its all-time highs, a majority of the time the stock market is at or within 5% of its all-time highs. And a 5% decline in the stock market is like a non-event. It's not called anything. It's just a 5% decline. If we get into the price of the stock market falling by 10%, that's called a correction. So that at least gets like an actual term assigned to it. So, during the times that the stock market is within 10% of its all-time highs, I mean, now you're getting into like a real majority of the time. And only, only 14% of the time, going back to 1950, has the market been below 20% of its all-time high. So what I take from this is that, as investors, we have to get comfortable with the market being at or near all-time highs. And I think we also could use this to our advantage to say, okay, when we're in these red zones of the market being way down, if the future is something like what the past has been, you don't expect to stay there for that long. And if you go back to the axiom of investing, we're trying to buy low, sell high, you have to be a little bit more aggressive about putting new money to work when the market is down, right? Like it might not stay there for very long. I mean, in 2020, we certainly saw that to the extreme, right? The market bounced back so fast, you barely got any time to invest at the lows before it bounced way back, right? But I think that this, you just kind of conditioning yourself as an investor to recognize that if the market continues to go up because new companies are being born, new companies are creating, or companies are creating goods and services that we're buying, and that whole process continues to happen in the future, you don't expect the stock market to be down at the lows for that much time over your entire investing horizon, which might be many decades. I just think this is a cool chart. There's a link to it down here if you want to go see it for yourself. I just think it's really neat because a lot of people psych themselves out and they say, I'm going to wait for the dip, right? I'm going to wait for a bear market. This year, if you were waiting for the bear market, you did not have very long to put your money in before it bounced back up. It's kind of a tricky way to invest. And again, going back to that longer time horizon idea with stocks, if you give yourself a longer time horizon, you have a higher probability of making money in the market. So if you're trying to gauge from day to day or even from quarter to quarter or year to year, that's sometimes not enough time to take advantage of the growth of the market, right? If you're in the market from day to day as a day trader, is the market going to be up or down on Monday, right? I mean, I don't know. It's like basically 50-50. It's 54%, 46%. And this is kind of data ending in 2018. But still, I think that probably still holds. It's basically a coin flip as to whether the market is up or down from day to day. But if you start looking at it over 10 years and then over 20 years, so far, and there's no guarantee, but so far, there's never been a 20-year time horizon where you have not made money in the stock market. So that's like reorienting yourself as an investor to skip over the short-term drama and focus on 5 years out and 10 years out and 20 years out, I think will reduce your anxiety and give you a higher probability of making real money in the stock market without being worried about, well, when do those gains happen? I mean, no one knows. Like the gains come when they come and we don't have any control over when that happens. But if you give it enough time, you put yourself in a better position to be there in the market when they happen, instead of trying to figure out when they start and when they stop. So where do we go from here, right? So I think after all of this, right, like if I was talking to someone who's doing this on their own, or someone who's starting out and someone who who kind of believes in the underlying thesis of the stock market as a wealth building tool, I would say you actually don't need to know the answers in order to build wealth. You don't actually need to know why the stock market does what it does. You just have to accept that the stock market goes up and down and sideways. And over long periods of time, we expect it to go up. So you don't need to necessarily know the technical reasons for why all these things are happening. I would say also know the difference between what you can control and what you can't control. There are so many things in investing and in life, right, that we cannot control, but that we spend a lot of bandwidth trying to figure out, even though it's an unknown. The stock market, what will drive the stock market in the future and over what time horizon is an unknown. So it's, if you start getting into the habit of trying to predict when I get in, when I get out, I think it's going to cause a lot of anxiety, and there are going to be plenty of times where you're not right. Focus on the long term. I think I've talked about that a whole bunch. And also, I think just finally, you don't have to be all in or all out. We go back to that chart that showed the stock market versus the bond market since 2007. Most people are somewhere in between, right? Where they have some money in the stock market, and that's the money for growth. And then you have some money in cash and bonds and safer stuff. That's the money for stability, right? And that's how most people invest. Maybe you want to figure out, do you want to be closer to the green line for the growth? Do you want to be closer to the blue line for the stability? There's a lot that goes into those questions. How much volatility can you take? How much growth do you need in order to reach your goals? If you have enough money right now, you might not have to take as much risk. If you don't have enough money right now, you might need to take more risk in order to reach your goals. But most people aren't or shouldn't be jumping in and out, we're all in, we're all out, and trying to time that. It can be, again, it only takes 1 or 2 times to be wrong for that tactic to move against you. So questions. This might be the first time ever that I've actually gotten through all of the slides that I prepared during the time allotted to me, and with 16 minutes to spare. So I'm going to go ahead and, my slide's down now. I can see you all again. This is awesome. So now I'm going to stop and see what questions have popped up, and I'm happy to answer however I can or offer any insight that I can. And there might be other people on the call who have insights they want to share as well. So I don't really know how to do this. I don't know if you can raise your hand or unmute yourself or put a comment in the chat box, but we'll figure it out somehow. Gwen, do you kind of want to?
Yeah, I'm going to put everybody up on the Brady Bunch. I see Donna raising her hand. Wait, there you go, you're unmuted. Good.
I just wanted to say thank you very much. Much appreciated.
That is so sweet. Thank you so much. I'm always not shocked, but I'm always impressed and humbled by the number of people who choose to be on these calls on their Saturdays, right? I know all days are the same now, right? there are no weekdays and weekends anymore, at least for me. But thank you for joining. I really, really appreciate it. And thank you so much for saying that.
Thank you.
Caitlin, I see you.
Okay, let me unmute it. So Sara, every year you have to reassure me that you explain it so simply and just shut your ears to all the noise, invest, maybe look at it once a year. This is all just noise. The 10% line is going up. But there is so much noise. It's just, I'm always astounded that there are so many people in the media and in the world that are paid to offer opinions and noise about all of these subjects that don't know any more than we do. And every time I'm like, can that be true? Can I really know as much as that? they must have something extra. And I think you always say like, no one can predict the future. They have a lot of fancy words. They can use all the lingo, but they cannot know any more than any of us. And I just need you to reassure once again in this time.
Yes, I mean, I am reassuring you during this time that that no one knows. And every single time something like this happens, what you do is you find that the people who got lucky, or the few people that did, that got it right, will be trotted out in the financial media in order to, talk about their investing prowess and how they knew and no one else knew. And so you should send us all your money so we can manage it. That happens every single time. There's always like financial celebrities that are born out of every crisis, right? And it's only a handful. A few of them, it is because of skill. Few of them, it is because of luck. And I would say like there's this whole financial world that doesn't have anything to do with real people. Like, I'm assuming the people on this call, that most of you guys are just normal people, and you're not hedge fund managers, and you're not like the rulers of the universe, and you're not out there raising money from other rich people, that we're just trying to make decisions for ourselves, like to the best of our abilities. So much of the financial media is geared towards the masters of the universe and convincing regular people that that's how they need to invest. And that is not the case. Like, and I know because my clients are normal people, and there's so many people here in this group that are normal, and people that take my classes that are normal, that if you just stick with the tried and true principles, and this is kind of going back to Warren Buffett, this is what he does, right? It's kind of the Warren Buffett-isms, is like, just like chill out, invest for the long run. The noise will never stop, so it does take training to ignore it, because that is the main thing that trips up really all investors, professional or non-professionals, is the amount of information is like drinking out of the fire hose. And you have to keep your eye on the long run. That's kind of why I'm always talking about that, because there's always something happening in the short term. Every single time, every class I teach, and now I have like the evidence from my Austrian Women's Investing Group meetings in the past. We would do this word cloud, like, why do you think the stock market might go down? And there's like the word cloud, right? And why do you think the stock market might go up? And there's the word cloud. Like, none of those things, like the names might change, but the idea that there's always something that we're worried about is never going to change. So if you wait to not be worried, you will never be in the market, right? So, and I'm worried about lots of stuff. I don't want to say I'm not worried about anything, but I'm not worried about the stock market in the long run. And there's lots of other stuff, but not the stock market in the long run. Is that helpful at all, or did that?
Yeah, every year I need to make sure that, I think there's something about being empowered with this information that you give us and we collect and sort of, polish and tell our friends about. But then we're not supposed to, the message is don't do anything with it, except it's a very conservative thing, which could take 0 time per week. And so I think there's a disconnect there for me between like, oh, I have all this knowledge, I'm going to run out there and do something. Wait, the message is don't do anything.
Right. And it's so hard. Like, and I have to tell myself that too, like, because like whenever there's a crisis, this is just like in general, there's a crisis and you say, don't just stand there, do something, right? But it's the opposite in the stock market. It's don't just do something, stand there, right? And if you stand there long enough, it'll work itself out, right? And it's counterintuitive, but behaviorally, there's just all of these studies about retail investors like us. That means like normal investors, not super ultra high net worth hedge fund people, that works to your benefit over time. So you can use that to your benefit, over you know, the hedge fund people who they have to be like quarter to quarter and doing something super fancy all the time. We just have to ignore it and come back in 10 years, right? That's all I'm asking of people, right? Is to just like don't spend your anxiety here. If you possibly can, let it go. And I know that's really difficult because sometimes people latch onto their accounts as the thing they can control when their lives are out of control. So I know it's harder than I make it sound. And I see people struggle with it all the time. So yeah, we just kind of keep on keeping on, you know, and, you know, just wait, just give me 5 years. That's all I'm asking. 5 years, 5, right? And then we'll check back in and we'll see how we did. Mark your calendar for August 2025, the check-in. Cool, thanks, Caitlin. Oh, what else?
There are a few questions that have popped up in the chat. Let me find it. Okay, so in today's market, it's really tempting to only put money into stocks that are undervalued right now. Is that a good strategy for both short and long-term growth? Or how should we be thinking about diversification?
Oh my gosh, that's such a good question. Who asked that?
Chris, who is muted still.
Hi, Sarah.
There you go.
Hey, how's it going?
Going good. Thank you. This has been great. I really appreciate your time.
Oh, you're welcome. Can I ask you a clarifying question on your question?
Yes.
Are you talking specifically about the old growth stocks versus value stocks discussion, or are you talking about like the actual price of stocks to invest in? I don't know if that question makes sense, but I would love to hear more about the background on your question.
So I also have a friend here who is listening, and it's actually her question. So I'm going to let her speak to that.
Awesome.
My name's Laura, and I was asking the question because I have a very small amount of money that I just started investing, and just as kind of as an experiment, and because I want to grow it over time, and I saw an opportunity in today's market. And so because I have so little to play with, I just started focusing on stocks that were rated as undervalued. Like the price dropped in March, you know, and their true value is higher, and they're still offering dividends, and the company outlooks are solid enough to maybe to survive this swing. But because I have so little to play with, I've kind of put all my eggs in that basket, and I'm wondering, like, should I really be diversifying? I've already doubled my money in a couple of months, so. So I want to think more long-term, you know.
Yeah. That is a really great question. And you may have inadvertently stumbled into like one of the controversial concepts of investing, which is growth stocks versus value stocks. So the kind of stocks that you're describing, it sounds to me like you're describing a classic value strategy, which is the idea that the price of these stocks is lower than what the company is worth. They pay a dividend, they're stable. And so, you know, over time, at least until recent history, there has value stocks have outperformed growth stocks. So growth stocks on the other side of the spectrum are companies that are growing their earnings very fast, but they might not pay a dividend. They're more the high flyers. So certainly like Tesla, like growth stock, right? But even Amazon and Facebook, Microsoft and Apple, you could probably make an argument for each camp. I would say that as you develop your investing strategy and continue to put more money into the market, I would diversify among those two styles. Because my hunch and kind of the way that I view the investing world, I think that the way that the economy is set up now and the way the market is set up now, a lot of companies are in industries that are winner take most. There's less competition, right? So if you end up being Facebook, the only real player in the entire new social media industry, It's really, really difficult for other companies to come in and compete. That once that flywheel gets going, it's really, really difficult to stop. So the very largest companies that can seem very overpriced if you're using kind of a traditional way of viewing stocks, I think investors are coming around to this idea like, oh, the biggest companies are going to keep getting bigger because now they have all the data, they have all the mechanisms set up in place to keep gathering the data to make their products and services better and more efficient, and that is a self-perpetuating cycle. Whereas in the past, before kind of this technological revolution, that started, beginning of the century, that wasn't there yet. So I would say, like, to give yourself balance, it would make sense, like if you focus on value to date, that as you add new money, you might want to start adding either like the type of fund or stock that diversifies away from that concept, or just like a broad ETF that has all of those different companies together so that you get some of the benefit of that. That would be my suggestion. That's not investing advice. It's just, it was a really good question. And congratulations too on starting your stock account and growing it and being brave.
Thanks.
Laura, did you also have the other question about, is it a good idea to invest in gold specifically?
No, that's me.
Oh, okay. Sorry, we have another Laura on the call. We can go to that one. So, Sarah, is it a good idea to invest in gold specifically? And if so, how do you do that?
That's a really good question. I will just acknowledge right off the bat that I have had a bias against gold for a long time. But it's a different asset class, right? So I would say that if you're in, sorry, I don't mean to be stumbling here. I'm gonna ask you a follow-up question. Why are you interested in gold? For what purpose?
Well, just kind of looking back on the chart that you showed earlier, it looked like, it was kind of in the mid-range between being the safest and the most high risk. So it looked like, it was kind of a good middle spot. It just seemed like something else to possibly diversify in.
Yeah. So I think as part of a diversified portfolio, certainly the case could be made for gold. I don't know what that percentage is. I mean, for me personally, maybe I could be talked into a 5% position. I personally don't have that and am not really looking to build that, but I could see that. Some people feel, for whatever reason, like they want a higher percentage than that. One thing that I do feel pretty strongly about is that gold over the long run is not a replacement for stocks. It's a replacement for something else in your portfolio. So that if you have like a 50% stocks, 50% not stocks portfolio, that the gold goes in the not stocks part. So it replaces something like bonds or something like cash, right? Like if you would rather not have dollars, like I can have this many dollars in my savings account. Well, what if you convert those dollars to gold or Bitcoin or yen or some other currency type thing? That's where I think gold fits in, instead of saying, well, instead of 50% stocks, I'm going to have 50% gold, right? Because gold isn't the same. It doesn't have the same long-term growth characteristics as companies, which are.
So is it safe to say then that's why you're more reluctant on that, is because you don't see the good long-term possibilities for it?
I tend to think of gold as like where you see it as a happy medium, I see it as the worst of all worlds. Like you get not well, the literal worst of all worlds, but they get all the volatility, almost all of the volatility without the upside. So instead, I'm just kind of thinking like, okay, if we're going to have to gut through the volatility, we at least need to be compensated for that, right?
Mm-hmm.
But again, like as a diversifier, I mean, if someone wanted to have 5 or 10% of their portfolio in gold, I would not try to talk them out of it, especially if you can hold on to it for the long run and use it for its long-term, I don't know, inflation, hedge stuff. Then I think it's fine. And you can do it, you know, you can do it physically. You can go somewhere and buy a bunch of gold coins and keep them in your house or in your safe deposit box, right? Or you can use a paper product like an ETF, like GLD or IAU. So it's like an ETF, or it's like a fund that owns gold.
Oh, okay.
I don't like the idea of having a bunch of gold in my house because like I lose it. I don't know. It seems like so silly, like, you know, like, but I have this whole sleeve of silver coins that I bought in like 2006 that I keep losing like as I move places, right? Because it's small.
Okay, so it sounds like even though it looks like it's on the midpoint of that chart, it really is a bit more volatile. It's not as safe as maybe what it looks like plotted on that chart.
Right. I mean, I would say that it depends on what you are looking at safety from.
Okay.
If you're trying to avoid volatility, then it's not super helpful because the price, if you look at a gold price chart, I mean, it has mountains and valleys just like the stock market.
Okay.
But if it's something else, then maybe the case could be made for it.
Okay. Thanks.
Good question. Oh, Donna has, do you have a comment on the gold? I don't know how to unmute you. All right, Donna has a follow-up on that, I think. Sorry.
So because I'm new to the group, I'm not sure, and you please let me know if this is appropriate or not, but I did do some investigation on gold in the last week or so, and one of the tools I used was I went to a news source about, you know, what Buffett is doing. So I usually don't typically follow Buffett, but I'm just starting to get into this. But he sold.
Elena, turn it down.
Caitlin. We've all been there.
He recently sold three got rid of one of the banks, I think it was between Wells Fargo, JP Morgan, and Goldman Sachs. But anyway, he sold completely out of one of them and sold several, millions of dollars worth of a couple of the other banks and bought gold. And I had never even considered gold before. And so anyway, if I think it was Laura that had asked the question, if she wanted to investigate a little bit more about, gold now. And there was also one of the other things I found out is that typically when there's a crisis, that that gold tends to do a little bit better. But I did invest, and so far I'm losing. But anyway, I just kind of was following what Buffett was doing. So, and that's the first time I did that.
Yeah, I mean, who's to argue with Uncle Warren, right? But certainly it sounds. But I think to your point, like knowing the why of why you're investing in something is really important because it allows you to stick with it, right? Like if the why of gold is like because I'm really worried about something catastrophic happening, that's a good reason. Like that's a great reason to invest in gold, right? If that is your worry as an investor.
Good point.
Like going back to the why, like why are you investing in stocks? If you're doing it because Sara said she thought it was a good idea, it's not good enough because that reason's not going to get you through March 2020, right? Like if it's like because I want to end up with more money 20 years from now, if that's something that you can come back to and stick with, right? And I think gold is the same thing. If you're like, listen, like I'm just trying to protect myself from a super worst case scenario that I think might happen. right? That's a good reason. And it doesn't mean like you can't sell it. It doesn't mean you won't lose money. Like if the catastrophic thing never happens, then maybe it goes against you, but it's still, it's a reason for you as an investor to make that choice, right? It's not mindless, and it's not just because someone told you to do it. It's like you're really like thinking through. So I think that that's important from an investor perspective.
Sounds like an existential exploration of investing in the stock market.
Well, thank you very much for sharing. That is really helpful. I mean, we talk about Buffett a lot here. So, again, who are we to argue? He's all right, right? Really good questions. I know we're over, so if I'm happy to stick around for a little bit longer if we have more questions. Maybe stick around until 4:45. So I'm happy to stick around. For those of you who aren't able to stay on the call, thank you so much for joining, and join us next month. Kirsten, hi. Lori, hi. So feel free to jump off, and thank you for sticking around. And always, I don't know if I put my email address anywhere on here, but feel free to message me through Meetup if you have any questions. And we will push this information out to the group next week sometime. So hopefully you found it to be valuable. But again, I'm happy to stick around for a few more minutes and answer any questions that people have.
Hi, Sarah. Hi, I have a question. It is about the stock splits that were just announced with Apple and Tesla. And I wanted to know your thoughts on those, and if you thought they were good for investors, or how do you think those stocks would perform long term with the splits?
Yeah. Oh my gosh, Kimberly, that's such a great question. So I have this love-hate relationship with stock splits personally. So on a stock split, there's nothing inherently good about a stock split, right? The idea is that if you own, okay, so let's do Tesla, right? So if Tesla today is at $2,000 per share, and the idea is we're going to do a 5-for-1 stock split. So on day one, you have one share of Tesla that's worth $2,000, and the next day you have 5 shares of Tesla that are worth $400. That is a mathematical equivalency, right? Nothing has changed about anything, right? But I know this from talking to people for however many years I've been talking to them. It has a psychological impact on people because almost every single person, I don't know if I've ever met anyone who's gone the opposite direction. When you ask people, would you rather have one share at $2,000 or 5 shares at $400, everyone chooses the 5 shares at $400. And I don't know why. I just know that it's true, right? Because at least from my surveys that I've done after teaching this all the time. So I think for investors, that psychological component is really important. I don't know over the long term if it makes a stock more valuable over the long term or a company more valuable over the long term, but I think in the short term it does because of the psychological impact. I always have people who reach out to me whenever there's a stock split announced. Hey, why don't we buy more before the stock split? I'm but it's the stock split is the same math, right? There's nothing about the split on its own that does anything. But then there almost is always a pop in the stock price after a company announces it. So I'm very so I think that it's fine. In my mind, if you wanted to buy Tesla before, this really shouldn't impact whether you do or don't. I mean, the price should have been baked into it the second after they announced the split. So it should already be in there, and there probably isn't very much split adjusted impact left. But that doesn't mean that people don't do it. If for some reason it makes you feel better to own Tesla at $400 versus at $2,000, the company itself hasn't changed, but people prefer to invest in lower price stocks versus higher price stocks. And so I am acknowledging that. I don't know if that answered your question, but I think behaviorally and like in the short term, it's important and it leads to price increases. I'm assuming, and I have reason to suspect that over time, what drives stock prices is earnings. So the most important thing to Tesla over the long run and Apple over the long run is announcing big profit numbers, earnings numbers. That's really what drives the price of the stock. Good question. Very timely. Awesome. Anyone else? Are you waving by, or are you raising your hand, Lori?
I have a question. It's sort of a devil's advocate type of question. So the stock market is high. There's not really a clear tie-in to what's happening now in our current environment. And so they're looking forward. The people in the market are looking forward and saying, okay, I think we're going to get out of this. Everything's going to settle down. But since they're already kind of jumped ahead, how can the stock price still continue to go up? Because they're already at like the happy state where, you know, everything's wonderful, even though we're not there yet. So it seems like to me that it either has to plateau or go down because it's not matched up with reality.
Yeah. I mean, yes. I mean, that's an excellent point, that if you've pulled forward all the gains and those gains are already assuming good performance in the future, what would contribute to an increase in price versus going sideways, waiting for the news to catch up to the price, or going down if there are disappointing earnings. And I think that in the short term, that would be, you know, as an investor, you might want to be thinking about like, what's in I have money to invest, right? What is my upside versus my downside in a situation like this? The downside might be greater in the short term because, you know, as new information comes in, if it doesn't substantiate people's views of the economy getting better, you would see dips, right? You would see people lose interest in owning stocks. I mean, because ultimately, I think if you get announcements with increasing earnings, I think that could be the catalyst that could keep people extrapolating that trend into the future. But if you don't get that, I think people will lose the faith that they have in the stock market at these prices. I would say that is not, like, to me, that's not, it might be a reason to not put a bunch of new money into the market, or, I feel like a good strategy for all times is putting a little bit in all the time, right? It's the dollar cost averaging, or like how you invest in your 401k with like new money going in over time, or if you have a chunk of money waiting to be invested, do it a little bit at a time so that as this works out over the next 2 years, if you're already invested, stay invested, because then if the market goes up, you go up. If it goes sideways, well then, okay, you're kind of redeploying your money over time to get ready for when it goes up again at some point in time. And if it falls, you're buying the dips. So I feel like that kind of strategy would mitigate that concern, because I think that that is really important here. Like if we really believe that earnings drive prices, and we're already making that assumption, like where do we go from this point in time? It might be sideways for some point in time, right? I don't ever want people to kind of fall into the trap of like jumping in and jumping out, but I think that nuance, I think that it also goes back to maybe Caitlin's point of just hanging in there, that I think people have an easier time if they don't get attached to the highs or the lows. Like the price is going to change. We don't know how it's going to change, or again, like we don't know the path that it's going to change. So if like we're at all-time highs, but I don't feel like this, I mean, this price seems like I'm not attached to it, right? You know, it can go up, you know, it can go sideways, stay the same, or you know, it can go down, right? And just like acknowledging that that's going to happen maybe would allow you in that case where you're like, oh, I don't really think there's a lot of upside, to stay invested through the ups and downs while maybe like taking the opportunity to buy the dips. Because I mean, that's a really excellent question. I think that's where a lot of people are. And personally, that's where I am too. Or if like someone rolls in with $1 million in cash today, I'd be like, well, I don't know if I'm going to dump that all into the stock market right now, but I want a plan to get it in for the long run. So that's a really good question. I don't know if that answered it, but I mean, that's the way to look at it at prices today. Really good. Oh, what else? Yeah. Jeannie.
I'm not a day trader, but I watch the market every day so I can learn about my stocks, and I don't get too worried. I mean, I have had a few stocks fall to zero through a learning experience, but so I was watching Tesla, and Tesla's low point during March or April was 400. So if you had invested on that low day, now you would be sitting pretty because of, you know, it's accumulated so much like Apple and also Amazon. But on the day it fell low, I mean, that's a lot of money for me, but I had trouble during the dip knowing when the bottom of the bottom was. I mean, they put the brakes on the market on a few days.
Mm-hmm.
That I forgot what it's called, but
yeah, circuit breakers.
It was such a crazy, I've just never lived through something like that. It was so scary. I was afraid I knew some stocks, one stock that I knew well, I bought some of it because it's a young stock, but with Tesla, it's such an expensive stock, I wasn't comfortable buying it at 400. But if I just bought 1 or 2 shares at 400, wow, that would just be, you know, a huge increase.
Yeah. Yeah, I mean, crisis investing is so hard. That's why the market is in crisis, right? Okay. Because it's so freaking scary that it takes, I mean, that's why the price is falling, right? Because not only are people selling, people aren't stepping in to buy, right? And it takes, you know, it only takes a few investors to kind of start wading back in to put in that bottom. But it's not in most people's wheelhouse. So I would say your experience probably sounds really familiar to even kind of like aggressive, like stock-centric investor, right? Like who was in plowing a bunch of money into the market on March 23rd, right? Probably, definitely not that many people because the market was down, right? So there were still more sellers than buyers, and there would have been zero way that anyone would have known when the bottom is. And so your expectations for yourself should not be that you're going to know that, right? The expectation for yourself might be like, okay, well, I really like Tesla. I mean, if you like it at 2,000, you know, then maybe you should like it at 1,500. Maybe I need to start talking about.
I thought even 400 was a bit much, but it's a popular product because it's something you can see. If you live in Austin, Texas, you see it everywhere you go. There's right. They don't even have to advertise the product. I mean, yeah. It's very interesting.
I know. I mean, and that company is, I think, its own thing, right? Because it's like the new Amazon, right? Like not that many people bought into the Amazon story until pretty recently, right? For kind of the same reasons, like, oh, its price is too high. We don't really see how this company ever makes money. It's been a very similar story with Tesla. So it would take like a pretty big leap of faith to be like, to think like, oh, as it's crashing to, you know, if the low is at 400, to think like, oh, this is a stop on the way to 2,000. Whereas, you know, there certainly must have been people who were like, oh, this is a stop on the way to zero. Right. Tesla blows up, you know. And with individual companies, I think that that's, you know, it's so easy to go that in with individual companies because companies do fail, right? A company does fail, you know, whereas if you're just kind of chucking it into a mutual fund or an ETF, I think it's a little bit easier to be like, okay, this might continue to fall, but all of these companies are not going to fail. Like a bottom will happen at some point, and I don't know when it is, but I'm just going to put $50 in or $1,000 in and then walk away and see what happens over the long run. So,
and what, a long time ago, you had a presentation where you were talking about the index funds and the ETFs and having a percentage of your portfolio in those. What was the percentage? Did you recommend a certain range or a percentage?
I don't remember. I mean, generally the way I think about it is that you start with the percentage in stocks versus bonds. That if you have $100,000 to invest, that your first step is how much is in stocks. Is it 50%? Is it 60%? Is it 80%? Is it 100%? And then figure out the ETFs or the funds that make up that portion. Right. So I think that usually the starting point where I start from is I hope that people start at 60% stocks, 40% bonds, unless they have a really good reason to be more conservative than that. And there are lots of good reasons, but 60-40 is a pretty good starting place because 40% in something safe for a lot of people is still, it's still a lot. It'll provide enough support while still giving the portfolio room to grow, but it's just a starting point, right? Like some people would say, that that's way too conservative, and some people would say it's way too aggressive. So it's just like a starting place. Like if you had to pick something, why not 60-40, right?
Okay.
But for you, I mean, if you're looking at Tesla and you're interested in that and you're following it, like, and again, like without knowing like what your overall strategy is, you might be like, oh, you know, like it's more like 80-20 and other 80% stocks, some of it's in funds and some of it's in individual companies.
I researched it for a presentation, a legal presentation we were doing on climate change. And it was a small part of it my part was about the laws that govern, you know, the laws governing just cars like Tesla and like the laws in California versus the federal law, because with the Trump administration, they're rolling back California's ability to clamp down on emissions, which is a huge problem in cities like Los Angeles. So one slide was on Tesla and the room just erupted with, oh, Tesla. It was so funny. And so ever since then, that was in February. And then the very next month, the pandemic hit. And then it's just been kind of interesting to see the stock just.
Yeah. A bunch of people just went from thinking Tesla was not a thing to conceding that it's a thing.
Yeah, it's interesting.
Like I give up on saying that it's not a thing.
Thank you, Sarah. This has been a very interesting presentation. I really appreciate it.
Thank you. Thank you for your question. We still have some people here. I'm still here. So I'm probably only here for 5 more minutes. I did promise my kids I would hang out with them today. So I told them I'd be home at 5:15. So, and I only live 10 minutes from home.
So we still have a couple questions in the chat box that we haven't gotten around to yet. Let's see this one. Yeah, Kate, I was totally gonna punt that question to Sarah. So you find the original one. Sarah, what are your thoughts on student loan payments? Do you think that there's a chance that they will ever just end them because they've stopped the payments for so long at this point?
I am not well versed enough in public policy to know what the potential for that is. So I'm going to have to punt on that one. I don't know, does anyone else on the call have some idea as to what that might look like? I mean, I think it's a logical place for there to be additional stimulus pushed out to people. It's cool, like there are some really interesting studies that are coming out now because do you remember there was a pizza CEO guy that I'm thinking it was Howard University. Like he paid all the debt of all the graduating class of last year, all the student loan debt from that graduating class. And so they've been able to show the graduates of the same university, graduates from 2019 that had their student loan debt erased versus graduates from like a year before, and do a side-by-side as to like what their financial lives look like 1 year later. And the differences are so stark, right? It's like, oh, the people that had their student loan debt paid for and forgiven were like getting ready to buy a house and, getting married and like kind of going through these milestones. Whereas the people who didn't have their student loans erased were just like struggling, right? Like just trying to make ends meet. And it kind of comes back to, if you have a bunch of student loans, what risks are you able to take, right? Like, first of all, are you able to save the money to do something like buy a house? And like, are you able to take maybe a lower paying job that has better prospects, or are you stuck in the job you have because you need the paycheck and you can't take the risk of changing jobs? So I think that there's like really interesting data now, control group data coming out to show what the overall economic benefit could be for something like that. I have zero idea what the appetite would be in Congress for pushing through something like that. Did that answer? Was that what the question was? Is it something? Okay. But I bet someone knows. It's just not me. I think it's really interesting. I think that anything that puts people in stronger financial positions is good for the economy, but I also know that then you get into like who deserves what and why and how you're going to pay for it and all that stuff. So cool. Anything else there in the chat box, or was that it?
There is one more that I think would be good to end on. So it's kind of just, coming back to a theme that you've touched on a lot in your presentation and in the Q&A. But Susan asked, I've had 2 of my stocks that have gained 50% in the last couple of weeks. Then they dropped down to gains of 40%. Would it have been wise to sell during that high gain time?
Yeah, that's a really good question. This is one that comes up all the time. People love like keeping their gains, right? So people love the idea that like, oh, I made this money and then I kept it. But I think that the more constructive way to look at it is like in this case where you're like, oh, like, should I sell this stock, right? I think it's, if you look at your portfolio and you look at those companies that you bought, and really it's kind of all of the companies, you can ask yourself the question like, would I buy this again right now? Right? If the answer is no, I wouldn't, then maybe there's a case to be made for selling it and moving on to something else, right? If the question is yes, I would, then it probably would lead you down the line of keeping it, right? So like if you had a company like, let's just pick on something like that's kind of easy to make the case for. So like if it's Microsoft, right? I bought Microsoft in March of 2020, now it's up 50%. My $100 investment turned into $200. How do I keep that 50%? If it's just a matter of should I keep the gains, I think that's not. That's not quite in my mind the right way to look at it, because then you'll start developing this habit of selling a company when it gains, even though the company might continue to go up. Right? So you start getting into the habit of all of these different decision trees. And I think that's really, really difficult to manage. Whereas if you're looking at your portfolio and you're looking at all the things you own, ask yourself, would I buy this again? If I was recreating my portfolio from scratch today, what would I buy? And if the answer is like, oh yeah, like I'd rather sell these stocks and reinvest in something else, and I have a really good idea of what that something else is, okay, then maybe it's time to sell and buy something else. But if you look at your portfolio and you're like, oh man, like I want to own Microsoft forever. Like I'm planning on never selling this. Then just let it, whatever the gains are, just let it ride. Because of the exponential growth, your expectation should be, especially for good companies, solid companies, the expectation might be that that stock doubles in price every 7 to 10 years. So if you own it long enough, you're going to see gains of 100%, then 200%, then 300%, right? That's what we're trying to get to. But if you look at the stock and you're like, I don't think this is going to grow anymore because, I don't know, like for whatever reason, then maybe move into something that will grow. But I think the 50%, the capital gain in and of itself, like preserving that capital gain, it'll suck you into short-termism, I mean, really, really easily. Whereas like, if you look at it like, oh, like pat myself on the back, like I made money in this stock. If you don't need the money right now and you're really investing for the long run and you still want to own that company, just let it do its thing, right? And don't get hung up on like the short-term high, the short-term low, and things like that. Or you're gonna suck yourself into a way of managing your portfolio that will probably not end up being constructive. And you also end up setting limits on yourself and your investments as to how much you think you deserve, right? Like, why should I expect to get more than a 50% return from my stocks? Well, I'm telling you, it's because of exponential growth, right? Like if you buy stocks, you want them to double every 7 to 10 years. So again, like you want to be coming back and seeing growth on top of growth on top of growth. Like it's okay for you to have that growth in the future. You don't have to cut yourself short just because you made like a really good decision in the short term. It does come down to the company, right? Like if it's a company, if it was like Eastman Kodak, right? Like that whole debacle, right? Like if you had somehow like made a bunch of money on Kodak and then you were like, oh, like maybe this is like, maybe Kodak's not the future of chemical manufacturing. Maybe I should sell it and take my gain. That's way different than if it's a company that you kind of know and believe in over the long run.